The previous video was a review of something that you had back in topic 4 before the quarter exam based on what we called T accounts. Topic 4 dealt a lot with journals, but we also needed to use the T accounts to kind of give a sense of the increased sides and the decreased sides of the various kinds of accounts. So that little video that you just looked at is very important, and it is just going to be crucial from this point forward that you know the increased sides and the decreased sides of the various accounts. So now we're ready to go from the T account, the skeleton view of the ledger, to the actual ledger itself. The spreadsheet you see on your page here shows actual ledger pages. These are based on the concept of T accounts, but they have obviously more detail. So let's take a look at these accounts. The ones that you see here are asset accounts. Let's take a look at the first one, cash. An obvious asset, something of value that the company owns. And this will tell you the name of the account number, which is in this case 101. One side note, GAAP, Generally Accepted Accounting Practices, would tell us that assets typically begin with a 1. All accounts are numbered. This is account number 101. Doesn't have to be, but typically you'll see all asset accounts begin with a 1. So let's take a look at the other parts of this particular ledger page. Date is there as of November 1, 2018. This account has a debit balance. We call this a debit balance. You see every account, if you look at these on the screen, every one has a debit side and a credit side, just as the T accounts did, but much more detailed than the T accounts. But it works the same way. Any asset, you should know by now, would show any increase on the debit side. So at some point in the past, this account increased by $12,300. So that would be shown on the increased side for assets, the debit side. If we lose cash, in other words, we pay money out, then this would be shown someplace on the credit side. Same way with every asset. Let's take a look at the other columns here. Description. This is used rarely, but there's space for a description if something unusual happens. If there's some note that needs to be made, this is where the accountant would put that information. Nothing needed to be put in this particular account. Next column is the REF column, which stands for reference. The reference column is used to show where this money, this $12,300, came from. It refers back to J9, which stands for Journal, page 9. So if the accountant needs to look at where this $12,300 came from, it would go back, he or she would go back to the first book of the business, the journal, and look at page 9. So those are the columns, and every asset is set up the same way. Let's look at accounts receivable down here. Second asset account, this account is numbered 102. Again, the date, November 1, 18. The reference is J9, also came from Journal, page 9, and it has a debit balance, we call this. $3,150 is the debit balance. So this is an asset account, as you know. Customers owe us $3,150. So that account has been increased at some point back in November or prior to November. And as of November 1, the debit balance is $3,150. If they owe us more money, it would be shown on the debit side. If they owe us less money, in other words, they pay the bill, it would decrease accounts receivable. It would be shown in this column, the credit column. Now, what it does not show us is who these people are. There could be 2 people, could be 1 person, could be 10. We don't know that. Eventually, way ahead in the second semester, actually, we will see that there's another ledger. This is the general ledger, but there's another, what we call a subsidiary ledger, that will show individual accounts of individual customers. We're not ready for that yet. So this simply shows us that some number of customers owe us a total of $3,150. Up here, inventory. is, again, an asset account. This is an account that's going to show what we own and that we intend to sell. So this would indicate that we have on our shelves, as of November 1, some kind of a product that's worth $63,923. So it's something of value, and it has increased in the past. It has a debit balance. Again, coming from Journal page 9. You would see the same thing with office equipment, office furniture, and building. All of these are asset accounts. All of them have numbers, and all of them have what we call debit balances. And all of them would show further increases on the debit side and decreases on the credit side. At the bottom, you see tabs, and these tabs are similar to what you've seen in the past. If we click on the next one, you will see that these pages show liability accounts. So they're set up the same way. Up here, an account title, accounts payable, and liabilities typically begin with a number 2. So accounts payable is typically the first one shown, and it is, in this case, 201 is the account number. And you see in this account a credit balance. You know, hopefully, you know that liabilities show increases on the credit side. So this tells us that we owe $500. We don't know to whom we owe it, and we don't know if this is one creditor that we owe money to. We don't know if it's a lot of people we owe money to. Again, there would be something called a subsidiary ledger that would break it down to show the names of all the people that we owe money to and how much we owe to each one. But this means the total that we owe is $500. If we owe more money, it would be shown on the credit side. That's the side that liabilities increase. If we pay off part of this $500, we would show that on the debit side, the decrease side. This company has a mortgage payable. Again, this is a long-term. Accounts payable would be short-term debts. These are long-term, perhaps 15 or even up to 30 years. We owe for probably a building, maybe land, that we have a mortgage with a bank. And we owe $97,500. That has been increased sometime in the past, but as of this date, November 1, we owe that much. That has a credit balance. This company also has a loan, again, a longer-term debt, perhaps for a larger asset like a delivery truck, maybe office equipment, that sort of thing. But we owe, as of this date, $8,200. This is account number 203. So, again, it has increased in the past at some point, and we owe that much money. If we pay part of it, it would be shown on the debit side, the decrease side. And the rest of these accounts for this business are blank at this point. Owner's equity, again, you know that this is showing the value of the business, the owner's value, the owner's equity, typically beginning with the 3, in this case 301, and the value of this business shows a $127,473 credit balance. It has increased sometime in the past. If it increases more, we would show it by another credit. Revenue, here we have sales. The revenue account for this company is sales, and it is going to be like any revenue account. It will be increased on the credit side. This is account number 401. Typically, revenue begins with a 4. You see the account is empty. There's a reason for that. We'll explain that later, why that at the beginning of November, the other accounts were all dated November 1st, 2018. This has nothing in it, and we'll explain why a little later in this course. But at this point, again, we have a revenue account called sales, and we have a bunch of expenses as well, and expenses, as you see, electricity expense, for example, will begin with a 5. 501 is the account number for electricity expense, and as the revenue, none of these expense accounts have anything in them at this point. We are assuming this is November 1, 2018, but there's nothing in them. Certainly we would have paid electricity and telephone and so on in the past, but there's a reason that these are empty at this point, and we will explain that again a little bit later. So those are what accounts look like. We have expense accounts, we have revenue accounts, owner's equity, liabilities, and assets. Hopefully you remember that the first three kinds of accounts, assets, liabilities, and owner's equity, are the kinds of accounts you would find on a balance sheet. The other accounts, revenue and expenses, would be found on the income statement. And we'll get back to that later. But the first step in our accounting cycle was journalizing. You've done a lot of that. The second step will be going from the journal to the ledger. That's what we'll be doing in topic 5. Later, we will be getting back to the statements, the balance sheet, and the income statement, and showing you how we get the information from the books of the business into those statements. At this point, I would ask you to go back to your course page. There'll be some questions to answer.